Hey, welcome back. Today we're talking about how much down on an investment property. So if you're interested in investing in real estate, you probably know that usually you need a down payment in order to purchase a property. If you're going to get financing from a bank or a lender, a private lender, a hard money lender, they're going to look to see that you've got some skin in the game to finance you for that property. So the question is, how much do you need to come up with for a down payment, and where can you access those funds? We're going to cover several different components of this, including looking at what kind of property you're going to be buying, what you're going to be doing with the property, and how to get access to private funds for your down payment. Check it out. So the first thing you want to know is what kind of property are you going to be purchasing, because that's going to impact how much you're going to need for a down payment. Let me explain. So for example, if you're looking to purchase a house, a single family home, and you're going to use it as your primary residence, your house, and you might be house hacking, or you might have a secondary suite in it or something like that, then you can get into that kind of a property with a much lower down payment than you would need in order to get into that same property as just a revenue property, as an investment. Because the banks and the big lenders tend to be a lot more comfortable loaning people money to purchase their own primary residence versus an investment property. They've just seen that, statistically speaking, over time, the chances of them having to foreclose on somebody's primary residence, their home, is much lower than the chance of them having to foreclose on an investment property. So they calculate that risk accordingly, and they're willing to loan you a lot more money on a house that you're going to live in. All right. Now, the other thing we have to take a look at is the kind of property you're buying. So there's single family homes, there's multifamily properties, there's commercial properties, all sorts of different kinds of commercial properties in there, including self-storage, mobile home parks, land, all sorts of different things, right? So it really depends on what kind of asset you're going to be purchasing, because that can impact the amount of down payment required. So for example, if you're looking at single family homes, quite often, if you're looking at that as an investment property, you can purchase those for about 20% down. Once you start getting up into larger multifamily type properties, the banks might be looking for 25 to 30% as a down payment. So you have to keep that in mind when you're looking at how much you need down for your property. What kind of property are you going to be buying in the first place? Next thing we want to look at is what kind of lender are you going to be looking for to finance your property. So most people are going for conventional lenders like the big banks or credit unions and whatnot. And those sources of capital are great because they tend to be the cheapest money available. They tend to have the lowest interest rates. But the challenge is they are the most persnickety as well. So they're going to really take a very close look at you and your finances, your financial situation, in order to approve the loan. Okay? So if you're looking at traditional lenders, you have to be prepared for that. If you're looking at private lenders or hard money lenders, they tend to be a lot easier when it comes to your own personal situation, your own personal qualifications, and they're taking a really hard look at the property itself. How much is that property worth? And how much cushion can they have if they loan you the money and you default and they need to foreclose on it? How quickly can they do that, and how easily can they recuperate their initial investment plus their expenses? So that's what they're really looking at. So typically, if you're working with the big banks, you can get a lower down payment requirement because they're really looking a lot harder at your personal situation. If you're working with hard money lenders or private lenders, you're probably going to have to come up with more money as a down payment, more skin in the game from you in order for them to make that loan to you, because they want to make sure they can get it back quickly. Does that make sense? So take into account what kind of lender you're looking for. Probably one of the best options there is to not necessarily work with a hard money private lender, but to find a mom and pop private lender, somebody who's not in the business necessarily of loaning money this way. That way you can get much better rates and much more flexible terms. Now, something else that you need to keep in mind when you're thinking about down payments for properties is when you're buying a property, it's not just all about the down payment. There are other expenses that you have to keep in mind, other things that you have to have money put aside for. So quite often, you're going to have to look at what are the legal costs involved with purchasing the property. What are the closing costs? What are the costs of doing inspections on the property? What are some of the carrying costs in the meantime? All of these different things can make a big impact. Insurance costs, renovations and repairs on the property. All of these kind of things you really need to understand so that you know not just how much money do you need to get the loan from the bank, but how much money do you need on top of that to make the deal work. That can be, the bigger deals. For example, we did a multifamily apartment building deal a few years ago, and the down payment was one thing, but all of the costs involved in creating the legal paperwork, doing the closing costs, getting the inspections, that came to, if I'm not mistaken, close to $50,000 in addition to the money that we had to put up for the down payment. And that wasn't even including renovation costs. Renovation costs came in at another $125,000. So again, this is all money that was not included in the down payment. So you have to keep that in mind. So how do you come up with some money for a down payment, especially if you're doing a single family home and you want to do it on your own? Well, there's all sorts of different things. I mean, if you've got savings, obviously that's the way to go. If you've got a house with equity in it, you could look at doing a home equity line of credit and pulling out money from your house to use as a down payment on another one. Lots of people do that. If you've got funds put aside in a retirement savings type account, so a 401k if you're in the States, or RRSP if you're in Canada, there are certain circumstances where you can use that money, especially if you're a first-time homeowner, to purchase your own primary residence. Or you can use that money to invest in somebody else's deal if you have a self-directed account, and they can use their money to invest in your deal. So you can get creative that way. You can look at increasing your income, so getting a side job, and then instead of spending the money that you're making there, just putting that aside and saving up for the down payment. You can lower your expenses and put that extra money aside for down payments. All of these things are different options. You can start looking at, if you're really tight for money, you can start looking at creative type deals. You can look for owner financing on properties. You can look for lease options or rent-to-own type deals that get you into a property kind of creatively. So there's all sorts of different ways that you can get the money and save up the money for the down payment, but there's also some creative ways that you can kind of get around that as well. Now, one of the best ways that I've come across and that we've helped our clients with when it comes to coming up with money for down payments is to use other people's money for the down payments for your properties. So how does that work? That means bringing on either joint venture partners or capital partners to help you buy the deal. So somebody else comes in with the cash and or the credit to qualify for the financing. You join forces, you do all of the work, and you share the profits. That's kind of like a joint venture agreement. Or you can bring on an investor after the fact, pull your capital out of the deal, have them put a second mortgage on the property, and just pay them a fixed rate on their money. That's another option as well. You can get a promissory note from somebody. If you know them quite well, they'll loan you money basically based on an IOU, and you use that money to purchase your property. All sorts of different ways to do this. In fact, I was just talking with one of our clients, and she was telling us about the way she got into her first little pre-construction condo deal while she was still in university. She'd read about some other university student that was just rocking it with doing pre-construction condo deals and making good money with that. So she got excited and she went to her family members and she got one of the family members to loan her the money. I believe it was just $13,000 years ago for getting into a pre-construction condominium deal. I think she only had to come up with a 5% deposit for that. And then as the condo was getting built, the values of the properties around there, I believe it was in Vancouver, were just going up and up. And she was able to sell her contract before the property was even finished. And I think she made $30,000 or $40,000 profit on that little deal. So she borrowed the money from a family member, used that to invest. That's how she came up with the down payment. So there's all sorts of creative ways that you can do that by using other people's money. Now, when it comes to down payments, it's really important that you keep a few things in mind. I mean, a lot of us, when it comes to a down payment, we're saying the less, the better, right? The less cash I have to come out of pocket, the less cash my investors, my joint venture partners have to come out of pocket, the better. We want the bank to finance as much as humanly possible. Well, I can understand that, but that could really bite you in the butt if things don't go 100% according to plan, especially if you have a variable rate mortgage. So at the time that I'm filming this, there's been a rude shock to a lot of people in the real estate investing business because bank rates have increased much higher than what newer investors were accustomed to. So old folks like myself that have been in the game and doing this stuff for years have seen interest rates go up and down over time. But if people got into real estate investing in the early 2020s when it was, rates were down at 1.5%, 2%, that sort of thing, and they thought that was normal, they've had a really big shock. So here's the challenge. If you are highly leveraged on the property, if you've got very little down payment in that property, then your mortgage is huge. And should those rates change, they go up and double like they have for some people, that's going to make a huge impact on your monthly payments and your cash flow. Chances are your cash flow is going to disappear and you're actually going to start going negative on that property. That's what a lot of people have seen in these over the last year or so. So be careful of that. You don't want to be over leveraged in that situation. Same thing is what happens if the value of the property dips for a little while at the same time that you want to sell it. So if you don't have any equity in that property, you're actually going to have to go negative to sell that property. Not only negative that you're going to lose money from the difference of the value in your mortgage, but also because you're going to have to pay for realtor fees to get it sold. So keep these things in mind. I highly recommend that, yes, you want to use leverage, but you want to use it very wisely. All right, speaking of leverage, if you're looking to leverage other people's money to grow your portfolio, if you're looking to bring on investors or joint venture partners, then I have a really good resource here for you. Excellent, if you ask me, but I'm biased because I wrote it. It's my book, The Money Partner Formula. This is my whole process for finding your ideal investors, getting their attention, getting them coming to you, pre-motivated, pre-qualified, and predisposed to invest in your deals. And that way, you can raise your first 6 figures, your next 6 figures in a matter of weeks, and even 7 figures in a matter of months, and just skyrocket your portfolio. Great news is, it's a free resource for you. I'll trade it to you for your name and your email address. Just click on the link in the description below or go to investorattractionbook.com. Get your copy today.